Hello and welcome to today's fast-paced video, which is going to be pretty extensive, covering whether those non-farm payrolls fireworks upon a stunning upside surprise can last, what are the prospects when it comes to equities, as examined from the bond market, credit spreads, and various other real assets ratios, and we'll cover cryptos as well. So this is going to be pretty packed. One more reminder from my Twitter feed. Making reasonable turns is the winning proposition in this market. Elevated volatility, sensitivity to headlines, and one has the opportunity to either predict and position oneself ahead of high confidence setups with limited risk exposure, and then reassess whether the prediction goes right or goes wrong and needs to be adjusted. And quick adjustment, not a panicky one, jumping in on an opening correction to go long is the winning proposition, which is what had been safeguarding client gains on Friday, even if those very bearish predictions that by some on Wall Street had been even in the negative figure territory had been not coming to fruition, not being announced, as the headline figure was a beat no matter what the solid case that I had been making for a bearish surprise on Friday had materialized. Such is the weekly perspective. Very strong, advanced decline lines, advancing volume to declining volume, advancing issues to declining issues. This is a very good picture Friday. So, can it last? This bullish candle had overcome an important Fibonacci retracement of the full slide to the tariff lows, to the tariff interim lows, I would say. This level had been overcome. So what is the prospect as prices had been accepted above this level Friday? Percentages of stocks trading above various periods of their moving averages had been painting a positive picture, still a positive picture, and the daily volume shows there is not enough selling interest either. So this is how far we go, as stocks are about to challenge more than a couple of dozen points to the upside. They have the potential to do so. So let's examine the sectoral view, which is still on a daily basis painting a risk-on picture. Note that utilities had been underperforming, staples had been underperforming, real estate had been not particularly strong, and the same goes for healthcare too. Financials spoke up, they had been behaving reasonably well, and the discretionaries had not been lagging badly on a daily basis either. The same kind of picture is mirrored on a full weekly basis as well. So the midweek correction, with the only daily lower note to speak of, had been clearly rejected, and stocks had been building without even intraday trepidations for higher prices, and it had been facilitated by the by the incoming macroeconomic data strength, and stock market had been leading the bond market, because if you look at the latest performance in junk corporate bonds, there is some kind of a budding, creeping, early stages of a bearish divergence being made as those bonds on the short end and on the long end had declined, which is a very notable sign when it comes to Friday. when it comes to Friday. This is what has helped US dollar to go higher, and the point that I'm making is that the bond market had not been buying this figure of non-farm payrolls, the headline one. It had been not embracing it with open arms, and that's a sign of concern going forward, and another kind of budding bearish divergence, this time in the intermarket sense of the word. Moving next, the bond market volatility shows that bonds are not seeing an elevated risk for now, which is what says that there is still some juice unless this trends meaningfully higher in the stock market advance, and stocks had been more fixated on the tariff headlines, and the momentum is building for some kind of US-China tariff resolution of this standoff being dialed back and ratcheted down, whereas bonds had been paying more attention to the incoming economic data and how it's going to be affecting the inflation and employment fronts. And the latest balance of data, those economic surprises had not been exactly, even though we got Friday's positive beat, which was quite rare lately, they had not been coming on the positive side, so bonds had been understandably not buying into the rally with they had not been buying it, embracing it with open arms. Credit spreads, these are still elevated, and they had not retraced nowhere near till the levels before all the Liberation Day run-up started. This is not painting a picture of decreasing risk, and this is what will, in the end, catch up with equities. It's a matter of time. It's a matter of not days, but short weeks, in my view. So much for the degree of developing bearish divergence or intermarket non-confirmation. We can see that as well tech to S&P 500 ratio had been acting quite tight lately, and it's still kind of pointing lower. Therefore, I completely understand and condone approaching this current stock market advance as a bear market rally, whether we talk bear market early stage or later stage. In every case, I do think that those last week and earlier discussed soft data to hard data translation would come back to bite equities, and the only question mark that I have is the status of the real economy at that time, and specifically where employment picture would be. And as I had made the very detailed bearish case on Friday, in Friday's video, that this would not be one that the Fed wants to see, especially if as they are loath to say about tariffs being one-off or kind of elevated cost basis when it comes to inflation. We all know how it turned out with the transitory call. It depends to be seen what kind of between a rock and a hard place the central bank would find itself in. But for now, it has no rate cut basis to be made, and that has been as well something that had powered Russell 2000 on Friday. Looking at other ratios, and this is still leaning on the bullish side, we see financials outperforming utilities, and finally peaking higher after the long ascent, turning sideways, and now a clear break higher in the ratio. Let's see how long it lasts, how long this lasts. Another ratio very well worth watching, and understandably more tame given the consumer reservations, is discretionaries to staples. Copper to gold is similarly painting a very cautious picture, and it kind of mirrors the junk corporate bonds picture of a creeping non-confirmation. And we can see in the run-up to Liberation Day how hammered this ratio got. Oil, very similar picture, and it took a bit longer for it to roll over, and the steepness of its decline this week is what is a very cautious sign as to the upcoming real economy hard data. Pay no attention to oil stocks painting a bullish divergence. Oil itself is going to be acting still subdued, reflecting the real economic prospects and the degree of negative economic surprises. Most positive sign for stock market bulls had been US dollar stabilizing, as I had called it, to stabilize above the 100 level. It has potential for further improvement, which is very good for stock prices and given and for what I see unfolding in this market as well. I had been clear that no matter the positive surprise in non-farm payrolls, gold and silver would be very subdued still, and they usually were, and the same goes for mining stocks. So this is a chart that is still well worth watching, and it's not in an uptrend, to put it mildly. Bitcoin winning play, consolidating strategy, pointing to its outperformance in the risk-on way. Another call that had panned well for trading signals clients, just as the precious metals ones, and very fast adjustment as oil fell from the 62 to 64 range to the downside, just as that call on oil had come to fruition. My joint page will help you decide what's right for you based on what and how you trade, so make sure to have full real-time access to everything I do, be it in the daily analytics and ideally combined with premium intraday channels, whether for real assets or equities.